All right. So some of us, this is our first time writing financial management, and some of us, this is not our first time. So if this is your first time, this is not your first time, you know how the structure of the professional exam is. Okay, it's going to be 5 questions, and you are going to be working the 5 questions within 3 hours. Okay, they will give you 15 minutes reading time, but your normal working time for the question is 3 hours, and you are going to be having 5 questions, which will be marked over 100%, and the pass mark is 50%, as we are all aware. But if you come to the financial management, what is going to be the question 1? What is going to be the question 1? Okay, so if you come to financial management, okay, the examination structure, question 1 will be for 20 marks. How the 20 marks will be allocated? You always have a question on environment for financial management, which will be for 10 marks. Okay. Then this will be A. This will be question 1A. So question 1A will be this one. Question 1B can be cost of capital, which will be for 10 marks. If it is cost of capital, it will be for 10 marks. It can be sources of business finance. Okay, it can be sources of business finance. Sources of business finance. And if it is sources of business finance, that will also be 10 marks. And they can ask you a question on right issue. The question that they will ask you over there can be on issues or right issue, how you can calculate the right issue, theoretical extra price and some issues there. Okay. So the question can be on right issue, or they can ask you a theory question for 10 marks, that will be 20. If you come to question number 2, will be business valuations, mergers, and acquisition. Okay, that will be for 20 marks. So the business valuation over there, we are going to be talking about issues of valuing shares, valuing equity, and also valuing debts. And also we can business valuation, mergers and acquisition, 20 marks. Please, from a timetable, when do we have FM? Do you have FM this evening?
Yes.
Is this evening? When do you have?
Is it normal class?
No.
The intervention?
Yes, please.
Yes, it's this evening.
What about PSA?
At dawn tomorrow.
Okay. Business valuation, mergers and acquisition, that will be for 20 marks. They can ask you a question on business valuation, or they can mix the two. They can combine the two. There will always be a question or a theory question on mergers and acquisition. What are those questions that will be asking you? We are going to be looking at it. Question number 3 will be time value of money. That will be 10 marks. And the time value of money, they have so many options to ask you a question on that. It can be on compound interest, it can be on annuity, it can be on sinking fund, or it can be on loan amortization. Then the B part of that will be financial risk management. Okay. And the financial risk management under question number 3 can be theory question or can be calculation, but mostly it's a calculation question for 10 marks. Okay. Then you also come to question number 4 will be investment appraiser. So the investment appraiser, they have the options to ask you a question on basic appraiser. They have questions to ask you on the advanced. They can also ask question on sensitivity analysis, asset replacement, lease or buy, and other issues. And that will be for 15 marks. Okay. And this will be for 15 marks. Okay. This will always be for 15 marks. Then the B part, the A, that is the A part. The B part will be on financial markets. So the B part will be on financial markets. So the B part will be on financial markets. And under the financial markets, they mostly will be asking you a question on maybe primary market or secondary market, or maybe the difference, or you should state some of the instruments that are traded in the two markets. It will always be under the financial markets. And the information can also be about the benefit of financial markets. Maybe you should explain some of the financial markets, or you should even explain the market efficiency, those weak, semi-strong and strong, or you should also explain maybe issues about Islamic financing, maybe their instruments. Okay, so this will be for 5 marks. Okay. Question number 5, the A part will be for working capital management. Working capital management. And then the working capital management can be on receivables, can be on cash, and can also be on what? Inventory. And that will be for 15 marks. Okay, mostly they will give you 5. They will give you 5 theory questions under the what? Under the working capital management, which they can ask you about. You should explain what overtrading is, the symptoms of overtrading, and also maybe the ways of overcoming overtrading. They can also ask you questions on if you want to invest. What are the things that you are going to be looking at? You look at your existing working capital structure, or you look at your cash demand. You also look at the return on the investment and also the risk of the investment. If you want to collect, how do you manage your receivables? They can throw a 5 marks theory question on the working capital management. Mostly, it is going to be 10 marks for calculation and maybe 5 marks for theory. And if you come to the B part or the C part, you'll be having issue on financial risk management. Financial risk management will always be for 15 marks. In this case, they can ask you a theory question. Mostly, they have been asking the difference between forward contract and futures. They can also ask you should state the methods of hedging your currency risks or your interest risks, which we have looked at that. So we'll be trying our best to look at the theory side, which will be the environment for financial management, source of business finance, financial markets, and the financial risk management. So we look at financial markets, and we try to look at other issues like capital structure and also dividend policies. Okay, so let's start with today's own. We'll be looking at those theory questions over there. So we'll be looking at issues under environment for financial management. So let's come to day 1. We'll be looking at issues of environment for financial management. And they can ask you maybe what is a financial management, or they can ask you about the decisions that you have to a financial manager has to make for the business to be successful, which are going to be the investment decisions, the dividend decisions, the financing decisions, and also the working capital management or the liquidity decisions. Okay, so We'll be taking some questions on that. They can also ask you questions on issues of agency problem. Okay. It is likely that we are going to be facing what? Large companies. And large companies, the owners are not the same as the people that manage the what? The entity. So management will be in the hands of other people and ownership will be in the hands of other people. Okay. These two people are going to be having different objectives. So the objective of management is that they want a big salary. The target of shareholders is that they want a higher dividends. These two cannot happen at the same time. So there's going to be a conflict between them. How do we resolve those conflicts? What are the likely costs that the entity or owners will be incurring to resolve these issues? We are going to be looking at that. And we also look at the objectives. What are the objectives of organization? These objectives can be classified as financial and non-financial. Some of them can be measured, some of them cannot be measured. So they can ask you to state those ones, those objectives that can be measured in monetary terms, that can be quantified. Profit maximization, increase in earnings per share, increase in revenue. Those are the objectives that we can actually measure. But if you come to issues like employees' welfare, paying your debt on time, these are not things that can be what? Quantified. So they can ask you about that. You have to be able to say something. They can also ask you about the stakeholders. We have some stakeholders. They can also ask you and the issues about the agency. They can also ask you questions about corporate governance. So you just have to read those areas. But if you are reading, your focus should be on the objectives. You have the financial objectives and non-financial objectives. What is their meaning and what are some of the examples? You come to also the issue of agency. What are the causes? What are the remedies? Then you can also talk about the decisions that are made by the finance manager. Okay, so you have to focus on those ones. But we are going to be picking some of them over here and see if we can use them to explain the other ones that are not here. So let's take question number 1. Theory questions: environment for financial management, sources of business finance, financial markets, capital structure, and dividend policies. Question number 1, Auntie Patricia.
Question 1. In relation to agency theory, highlight 3 types of conflict between shareholders and government. Then propose 3 solutions to the conflicts identified in AI above.
Okay, if they are talking about agency theory, okay, we have an issue of agency where one person is going to contract another person to act on behalf of what? The person who is contracting. So if I'm there, I want to do something, but I don't have the time to do it. So I can say, oh, come and do this for me. You are going to do that thing on my behalf. So you are going to act as an agent. You are going to carry out that particular responsibility on my behalf. So you carrying that particular responsibility on my behalf under an agreement, you are doing what we call, you are playing the role of what? An agent. So I will not be available, but you will be available. So whenever you have situations like this, go and do this for me. Okay, so if they're talking about agency theory, they are talking about that relationship where one person is going to be asking another person to act on his behalf. That's what we call the agency. That is a theory. Okay, what is going to happen? In business, owners are the people who are providing capital to the entity. Okay, and they have different people who are coming to manage what? This capital for them. It's just like I've opened a shop and I've employed you as a manager of that particular shop. Okay, your purpose is that you have to go to, at the end of the day, you want to go to the house with something in your pocket. But my purpose is also that at the end of the day, you should be able to what? Give me enough money for whatever investment I'm making. Okay, you want to go to the house with something in your pocket, and I also want to go to the house with something in the pocket. If you are going to the house with a lot of things in your pocket, there's no way I'm also be satisfied because I'm the owner. So what is going to happen is that we are going to be pursuing our own different what? objectives. You are also going to be looking for ways that you can get money and send it to the house. And I'll also be there thinking that you are going to be doing things to generate money for me. There's always going to be a problem. Why? Because these two people are going to be having, the two of us are going to be having different objectives. And we also be looking for ways of satisfying this or achieving these objectives. Okay, this happens in large companies. The issues of agency theory happens in large companies. Because if you have a small company, you have a small container, you are the owner and you are the manager. So nobody is doing anything on your behalf. You take your own decisions and you are held responsible for whatever decisions that you have taken. But if it is a large company that the owners don't have the time, they have to appoint people to now come and do the job for them. And when do we have the conflict? We have the conflict when the managers or the directors are now pursuing their own objective instead of looking for ways of maximizing the shareholders return. And what are the ways that we can have this conflict? This is what they're asking you. What are some of the ways that this particular conflict can arise? That's what they're asking for. But basically, these conflicts are being grouped under 5 headings or 5 types. Okay, so we are going to be looking at them. Or if you say it, something that is likely to be a conflict, there's no problem with that. They can mark you. Okay, but if you're able to state them, the types also, how they are being grouped, there's no problem with that also. So we are going to be taking them one by one and be looking at how we go about them, their meaning, and also how we can resolve those issues. Okay, yes, someone should help us. What are the ways that these conflicts can arise between shareholders and government? If they are talking about government, they're not talking about public individuals. They're not talking about Nanado. They're not talking about Nanado and his government. No, they are talking about those who are governing the entity. They are talking about management. Yes, Eric. Yeah, Senior Mike, I saw your hand up.
Yeah, so you're saying we should start answering the question. That is the highlights, the conflict that can arise between shareholders and governments.
Yeah.
Okay, so one of the conflicts can be differences in objectives. So the shareholders' objectives may differ from that of the management. Shareholders' objective is to get a return on their investment or the return on the equity they've placed in the company. Whilst management are looking at a short-term view, like profitability of the company. So that can be one of the conflicts that will rise between shareholders and management.
Okay. That is not bad. Okay. Do you have anyone who can help us?
Good evening.
Yeah.
One of the managers would rather want to grow the size of the company by increasing the sales or the turnover of the business rather than to increase the shareholder returns. But the stakeholders or the shareholders will
Is it my network or
I think it's hers because I'm getting the same feedback.
okay. Yeah, Senior Manuel.
about increasing the share returns.
Yeah, Senior Manuel, I saw your hand up.
Yes, sir. I think another type would be the separation of ownership and control. Those who owns the company or the business are not, because those who own the company are not those who are controlling it. There is also a conflict between the shareholders and the government. We have the shareholders controlling sorry, we have the directors controlling the business, the management controlling the business, but the shareholders who owns it are not the ones who are controlling it. So it brings conflict amongst the two, because maybe the shareholders would want a particular direction or would want a particular thing to be done, but management would do otherwise.
Okay. All right. So these conflicts are being grouped under five basic headings. We are going to be looking at them. But you can. There's no mic.
Hello, Senior. Please, I see the conflict between shareholders and government. I don't know if it is shareholders and management, or I'm clarifying.
They are talking about the government doesn't mean Anado and his government. They are talking about those who are governing the entity. That is a government.
Oh, okay.
No.
Okay, sure. Okay, sure.
Oh.
Thank you.
Hello.
Yeah.
So to answer the question, I think one is the moral hazard.
Okay.
Yeah, that's where the managers have interest in receiving benefits from their position, as in the positions they hold. They are looking up to getting, benefits from their position, whilst the shareholders are also seeking to maximize their wealth. So I think the moral hazard is one, and probably the effort level. Yeah, okay. I think that's what I can say.
Okay. Okay. All right. I saw a hand up.
Say.
Yeah.
Please, I wanted to say asymmetry of information.
Signalanos,
Yes, please.
can you also say that top executive compensation?
Can we also say that top executive compensation?
Yeah.
How would that
So
bring?
Okay. Like example, the management. Okay, the management and those board of directors. The management the board of directors may have other compensation that they get rather than their salary.
But the compensation will be approved by the board. So if the compensation is not good, they are not going to be approving it. Okay.
So management may also see that, okay, the top level are doing this, so they also employ a way that they also get other bonuses too.
Okay.
I don't know. Yeah.
Okay. No problem. All right. So yes, they are just talking about the conflicts. Okay. What are the differences that will be coming? Okay. The types of conflicts. So they are asking about the differences that will be coming. Okay. You just have to, yeah, Auntie Esther, I saw her now.
Another type of in the time horizon the long-term financial plans and objectives. Since it takes time, the value of shares to be redeemed, why they manage the short-term returns and save their bonuses, which are due to their short-term performances.
Okay. Okay. Thank you. Yeah, I saw. Okay. I saw the hand up. Yes, Narima.
So I want to talk about the earning retention,
Okay.
where managers to keep most of the profits that they'll be getting for the business. Where owners of the business want to keep profits for the expansion of the business. Meanwhile, managers also want higher wages and salaries based on their responsibilities. So
I'm with you.
sorry. Let me attend to something.
Okay. So these conflicts, the conflict that they are talking about, the types, they're just talking about the areas of the conflict. So the areas of the conflict, anyhow you write it, they all follow under 5 different areas. So the first one, so the areas of conflict, okay, or the types of conflict. You can also answer this question by the types of conflict to be conflict as to what dividend payments, or conflict as to what investments. Okay, conflict as to the dividend payments and also the retention. You can put it anyhow, but just that you should explain it in the situation where there will be a conflict, there will be a disagreement between management and what the shareholders. So we always look at what we call the moral hazards. So these conflicts can be grouped as what we call the moral hazards. Okay, if you are talking about the moral hazards, we are talking about a situation where management will now be acting what abnormally. Why? Because they are entitled to what? Cash. So they are entitled to bonuses. They want cars. Okay. They want to drive Porsche cars. They want a company to buy them cars and those kind of things. Okay. So since we want to drive companies cars, we want bonuses, we want per diem and those kind of things. Management will be doing things that are not going to be what? Complying with what management wants. So a manager with this level of what? Level of expectation to these benefits, this person is going to be acting in a way that is going to be different from how shareholders want things to be done. So a situation where management will now be behaving or will now be doing things that will not be in accordance with what shareholders want because of their entitlement to certain what benefits or certain incentives. Those things are classified as those behavior. They are classified as what we call the moral hazards. Okay. We also look at what we call the number 2. We can also have an area that we call the risk. Okay. The risk aversion. Okay. All right. What is the purpose of management? Apart from the salary, they are also seeking for what? Apart from the salary, what are you also going to be seeking for as an employee of an organization?
Promotion.
No, forget about a promotion.
The
The
survival.
profitability of the company.
The profitability is not your concern. If you're with the organization, it will be your concern. But there is, yeah, your main issue is the job stability. Okay. Job stability. You are concerned about your job stability. Okay. Because of this particular interest of management, they want to keep their job. They have families. They want to keep their jobs. So they will not be what? They will not be investing in certain projects that are going to be giving return. You know that project that is going to give you a higher return will always come with a higher level of risk. Okay, the management are afraid, the fear of maybe the company collapsing, the fear of the company collapsing. Management will know what, will not undertake projects that are profitable, because those projects are going to come with what, a higher level of risk that management is seeing that it is going to be what, affecting the company, or the company might collapse and they will lose their job. But the purpose of the shareholders is to increase their return. If I want to increase my return, it means I have to take a higher risk, because a project with a higher risk is likely to give you a higher return. We want to maximize our worth. How do we maximize what? How do we maximize that? We have to invest in projects, but the management are concerned about their job stability. So they are going to be feeling reluctant to go into certain projects, because they look at the risk level of that particular project and they think that if they should go ahead, the company will collapse and they will also lose their job. So see, management will be feeling, management will be thinking that we cannot undertake this project, but shareholders want that project to be undertaken, because if that project should be undertaken and is successful, it is going to add value to them. But management will be looking at their job stability, the risk of losing their job, and they will avoid what, undertaking that particular project. There is going to be a fight. There is going to be an issue there. We want you to do this and you want to do that. So because the risk aversion has to do with the level of project, the risk level of a project that management is willing to undertake, and what the shareholders are also expecting management to do. So we have the risk aversion. Okay, a situation where management will be concerned about their job stability and they will be ignoring projects with higher returns, projects that have the potential to increase the wealth of the shareholders. They will be ignoring those ones because the fear of the company collapsing, and they will also be losing their job. And there's always going to be a problem over there. And we also have what we call the effort level. Okay, there also be a conflict as a result of what, how management is contributing to the company. So we have this one. We can also have the conflict as to what we call the effort level. Okay, the effort level, we are talking about the commitment of management. Okay, you know that, okay, this is very simple. You see, if you go to most of the government sectors, they will say that, like, if it is 5 p.m., people will close. And if you say, they will tell you that, okay, the job is not for my father. That's why we are talking about the effort level. Okay, if that should be your own job, you stay behind to do whatever is necessary before you go. Okay, because the company is not your own, you'll be putting in less effort and be demanding a higher amount of money. So there can also be a conflict at the what? Looking at the effort management is putting in before demanding the amount of money that they are demanding. Okay, so management, they are not showing any commitments. The energy that they are putting in there, the energy that they are putting in there, the energy will not be equivalent to the amount that they are taking. And shareholders are going to be talking about this. And there's going to be a disagreement on that particular issue. You don't come to work early, yet you want your salary to be paid on time. There is going to be a disagreement with that. This is going to happen. You can try it. You are going to be having issue with your boss every day. That's what we call the effort level, the laziness and all those things, how you approach the work, the effort, your dedication, your commitment to the work. If you're not doing it very well, if you're not dedicated, the effort that you're putting in there is not that justified with the amount that you are receiving. There is always going to be a conflict. So we also look at the conflict at the effort level, the effort that management is putting in. Does the effort compensate the amount that we are giving to them? There's always going to be an issue as regards to the effort. If you are doing much, the shareholders will recommend you. But if you are not doing, they will always question your attitude and your dedication and commitment to the work. And we are going to be having disagreement with that. So we look at the effort level. We also look at what we call the earnings retention. Okay. We always look at we also look at the earnings retention. The earnings retention has to do with the dividend policy. You talk about the earnings retention. What portion of the earnings for the year are we paying in a form of cash, which is dividends, and what portion are we retaining? Okay. Management are aware that, okay, the amount of salary that they are going to be taking does not actually depend on the profit that the entity is making. It depends on the size of the entity. Okay. So because of that, instead of them paying dividends or higher dividend to the shareholders, because we know that one of the ways of maximizing the shareholders' wealth is through what? The dividend that they are going to be receiving. Okay, instead of them paying dividends, they will now be trying to return more profit to undertake projects so the company can grow and their earnings will also what? Their salary and also those things will also what? Will also increase. So we are going to be, management will be having issues with what? Shareholders on the portion of the earnings should be retained and a portion of the earnings should be what? Should be declared as dividends. Management will not be paying a higher dividend. It is never going to be possible. They would like to reinvest the profit so that the company can grow, and they also demand for what? A higher salary at the end of the day. So there are always going to be a problem with what? What portion are we paying as dividends and what portion are we retaining as what? As profit to run other projects. So this has to do with the dividend policy of the entity. Management will be keeping a lot of money to grow the business so that they will also ask for maybe increment in salary because the company is now growing. But shareholders will also be interested in what? Paying a higher return or paying a reasonable return on their investments. So this has to do with a portion of the earnings that management will be giving out and a portion of the earnings that they will be retaining in the organization. All right. I saw a hand up.
Yeah, I wanted to ask, is it intention or retention?
Is that intention? You are saying, is it intention or what?
I'm asking whether it's intention or retention.
It's retention, to retain, retention, not intention. I hope you're okay now.
All right, thank you.
So we also look at another one, which is the time horizon. Okay, the time horizon has to do with management issues as to investments. Okay, management are interested in profitability. They want shareholders to know that, okay, they are doing well. So they will be undertaking short-term investment that are going to be impacting the profit immediately. But the shareholders are interested in the long-term success of the organization, because the long-term success of the organization is going to be increasing their wealth, not the short-term. But management will be interested in what? Measuring their performance today. So they will be investing in what? Short-term what? Securities or short-term investments. What management shareholders are going to be preferring what? Investment in long terms that are going to be what? Increasing their wealth. But management wants people to know that, okay, they are doing well. So they will be investing in projects that will last for maybe 1 year, 2 years. So we look at that and say they are doing well. But the shareholders are interested in the long-term survival of the organization. So there will be a difference in the decision for investments. Shareholders are interested in long-term investments. Management have appetite for what? Short-term what? Investment, because they want people to, or they want their performance to be assessed as they are doing well. So they will always be interested in what? Short-term what? Investment as against management's appetite for long-term investments. Okay, I'm saying that this particular question, okay, you can also look at this question and without writing the moral hazards, the risk aversion, the effort level, and the earnings retention, the time horizon, you can also write this as what? Conflict on dividend payments. Conflict on dividend payments. So if you have the conflict or conflict as to dividend payments, Then you explain why or what you mean by conflict on dividend payment. So you can just say that shareholders want a higher return on their investment, which will be through dividend payments. But the management also want to increase the profitability of the entity by retaining what? A higher portion of the earnings. So if management is not doing what shareholders want, there will be a conflict there. There will be a problem there. There will be a disagreement there. You can also say conflict on the what? On or issues as to management commitments and also management dedication to the job that they are doing. That will be the effort level. Okay. You can also say management demanding for increase in pay or management demanding for what? Abnormal what? Allowances. That is also going to be a conflict because shareholders are going to be paying this. They are going to be paying you this salary, and this salary will be taken from the profit that we are getting. So if you are paying your higher salary, it means that lower profit will be available, which you might not be able to pay dividend out of it. And you can also say conflict to investment decisions. Conflict on investment what? Decisions. Management are going to be preferring what? Management are going to be having appetite for short-term investment as against shareholders what? Appetite for long-term investment. You don't have, no, you just have to put the point there to indicate that, okay, this point is likely or this point is going to cause a conflict or a disagreement between management and also the shareholders. That is it. But everything that you are going to be saying will be grouped under these 5 areas. Everything that you are going to be saying will be grouped under these 5 areas. Okay. They say that you should explain how you can address any of these 2. Okay, so you can pick any 3 of them. How do we resolve the issues of moral hazards? How do we address the issues of moral hazards? Or you can just talk generally, you can talk about what the remedies to the agency problem. What are some of the ways of what addressing or reducing agency problem?
Auditing the accounts of the firm regularly.
Okay, so the solution, one of them can be employing the service of any independent third party. So auditing can be part of this. Auditing should be done by independent third party. Yes, Nakafu.
Seeking legal advice.
Okay. Okay. Please, can you
regular this reporting of financial statement.
Okay. Can you give us some little clarification on the no answer? No answer is wrong. You just have to be able to convince the examiner about what you are saying. So what are you going to be adding to the seeking the legal advice? What are you going to be adding to that?
So when okay, it's like Abanga wants to talk. Hello.
Hello, my point was different.
Oh, okay.
Yeah.
Okay. So seeking for legal advice, some of the conflicts cannot be resolved between the managers and then the shareholders. So there are times that legal people, like lawyers, have to be brought in to settle issues with between them and also to advise them on the right path to take.
Okay.
So that conflicts can be eliminated among them.
Okay. Okay. So right now, okay, involving a third party who has what? So you can also take legal action against whatever those people are doing. Okay, that is so with the explanation, I think that will be acceptable at this level. Yeah, Scenario Emmanuel, Michael, yeah.
Okay, so yeah, asking managers of the company to take up shares so that they can become part owners of the company.
Okay, so we can also introduce motivational packages or incentives to them, which one of them will be share options. We'll give you a target that if you're able to achieve this, or if you're able to work with us and do this particular thing, we are going to reward you with shares. So we can also introduce the incentive schemes. or maybe performance-related schemes. If you're able to achieve this, we pay you a bonus of this amount. So as soon as you are looking at the money, they're asking that if you are able to increase sales by this, if you're going to do this, you want the money. You want the money. Now they are telling you are the director of Ghana Guinness, and they want to award you with shares so that you be a director of Ghana Guinness. What are you saying? It's even a plus on your report card. So you are going to be of good behavior. So we can also introduce what we call the incentive schemes, and one of them can be the share options, that you become part of the shareholders, or you become a shareholder of the company if you're able to do this, if you're able to do that. Okay. Yeah, Sinemanuel, Sinamichael.
So I was about saying you tie managements, you give them you tie their compensation against their performance.
Okay. So let's explain the share option as a separate point. Then we bring this one as performance-related what? Performance-related
compensation.
Okay, incentives. So if you perform better, you'll be paid based on your performance. Okay. All right. What again?
So we also have internal firing and dismissal.
Okay. So, okay. See, now you don't have that. Okay. So we have threat of dismissal. You can tell them that next time, if you don't do this, there are a lot of people there looking for a job. Okay. There are a lot of people there looking for a job. So next time you repeat this again, next time you don't take us our order, that is the end for you. So we can also use the threat of dismissal. What again?
Sinalano, that point is very good for in Ghana here.
So please, what's the difference between the performance-related incentives and that of performance-related pay?
Performance-related pay and performance-related incentives. Asina, is that what you're asking?
Yes, please.
They are all related to pay. So if you do well, we are going to be paying you. But if it is performance-related, means that your actual work will be determined by your actual salary will be determined by what you are doing. Okay, if you come to the workplace and work for 2 hours, we pay you on 2 hours, or we pay you based on the 2 hours that you have worked. But the incentives can be okay. We pay you your normal one. But if you're able to achieve this target, we can add bonus to your normal salary. Okay, so the performance-related pay is, okay, if you work for 2 hours, we pay you for 2 hours. Okay, if you are coming to work for 2 hours, we are going to pay you for 2 hours. But if you're able to increase your output by 10%, if you are able to increase your output by 10%, we can give you additional maybe 10 cedis per the unit that we have produced. Okay, so that is the difference. One is actually the amount that you are taking home. That is your basic salary. That is the pay. But the incentive will be the additional that will be coming in addition to your pay. All right. Yeah.
Okay, then say that
All right. Yeah, I saw someone was mentioning my name. Yeah, someone was mentioning my name.
You were
I
saying
was
as
saying that
performance related to here.
the performance-related
Okay,
pay as
okay.
Sure.
So we are all looking for more points. Performance related pay. Okay. Yeah, what again?
Okay, so it's also because of management's appetites for risk aversion, which will also lead to the company losing in the long run. They have their activities has to be overseen by a board.
Okay. Okay. So that is what, okay. So we can classify that one as part of the auditing that part of the auditing that our brother is saying. So that we can also explain that under the auditing. Okay. We can also use the threat of hoster takeover. So we can also scare them with the takeover. Where if you talk about a hoster takeover, it means that the company that is going to take over, they will come with their own management. So if you are there, if you are fully, a company will come and take over. We allow a company to come and take over. And if they are coming to take over, it means that all the employees will be laid off and you're also going to be part of them. Since you care about your job, it means that you're going to be doing the right thing. So we can also use the threat that, okay, if you don't perform well, if you continue behaving like this, we just ask an entity to come and what? To come and take over. And if they are coming to take over, it will not be a gentle takeover. It will be a takeover that they are coming to do what we call a restructuring. They are bringing their own people into organizations. So you are no longer going to be there. So you'll be gone. All of you will be sacked. They are coming with a new management, with everything new. Okay, in terms of the structure of the organization. So you are not going to be there. All right. So we can also use that to scare them, and they will now get back to doing what shareholders or the owners want them to do. Okay, these are few of them, and you should pay attention to this area. Okay, it's also one of the areas that they can examine when it comes to the environment for financial management. Don't forget about the decisions that the finance manager must take. Don't forget about the objectives. We have the financial and the non-financial objectives. You should be able to differentiate them and bring the examples under them. Okay, and maybe some other issues that you can also look at under that place. All right. B. Auntie Patricia.
As financial management is concerned with efficient and effective management of a firm's financial resources, the financial manager is mostly occupied with making important decisions to ensure shareholders' wealth maximization. Required: A. Discuss the interrelationship between financing decision, investment decision, and dividend decision in a corporate entity. B. Differentiate between corporate ownership and corporate management. How does the separation of these present problems in corporate life?
Okay. So that is it. They say you should discuss. So these are the decisions that the finance manager will be making. They are actually 4. They can ask you to explain them, or they can ask you to state examples under them. Okay. So they're asking us to, okay, is there any relationship? Is there any interrelationship between these decisions? That's what they're asking you. Okay. So they are asking the interrelation between financing decision, investing decision, and dividend decisions. Okay. The decision first must be investment decision, which will be connected to financing decision, or it can be dividend decision that will be connected to any other thread. How you are going to be, it doesn't mean that financing decision, so you should link a financing decision to the investment decision. No, if it is the investment decision that is bringing the financing decision, that link should be established. Okay, if there's any relationship between the dividend decision and also the investment decision, that link should be established. Okay, so let's come here. Is there any relationship? Are they linked? Are these decisions, is there any linkage between these decisions?
Yes, please.
Okay, how are they interrelated? Before you decide on where to get your money from, what action will bring about where should I get money for? Okay, you can't just stand up and say, oh, what will I get 10,000 from right now? No, you might need a 10,000 for something. Okay, so what will be bringing the idea of where are you going to be taking the money from to do whatever you want to do? Yes, Mike, I saw your hand up.
Yes. So when you have an investment opportunity,
Okay. Okay. All right. So yeah. So establish the link. Let's see.
Okay, so if you have an idea, you would need money to be invested in, and which you need money to run the idea or the program you have. So which will lead to you looking for funds
Yeah.
to be invested in your idea. So once money is put in your idea or your project and it starts yielding profit, you then go back to giving returns to the individuals or companies that invested in your idea. So that will also be classified as dividend decision.
Okay. 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 That is not bad. That's not bad. Okay. Yes, there is interrelationship between these decisions. Okay, how are they interrelated? Financing decision has to do with, okay, where do we get money to do or to carry out a particular activity or a project? Okay, this project is going to be an investment. We need to do an investment. If you need money to buy a car, that is an investment. The car will be giving you a benefit. That is an investment. If you need money to buy stock to sell, that is an investment because you are going to be getting return on whatever you are going to be doing. Okay, so before you decide on where to get your money from, before you make a financing decision, it means that you have already identified an opportunity. You have already identified an investment opportunity. So where do we put our money? We have identified that, okay, right now, if you come to Ghana, most of the areas, they don't have cars that can convert them to wherever they are going. So let's buy car for total business. Okay, that is an investment decision. That is an opportunity decision. You cannot first decide where you are going to be getting money before, or you get the money before you decide on what they are going to be doing with the money. No, you are going to be having an idea before you decide, okay, where do I get money to finance, or how do I get money to run this particular idea? So it will always start from the investment decisions. So we identify opportunity that, okay, this opportunity is going to be profitable, but do we have the funds to undertake that? Okay, how do we carry out this particular opportunity? You want to establish what? Fast food. That is the opportunity that you see that it is very profitable nowadays. Okay, how do we make this material? How do we make this particular decision a reality? You have to now be asking yourself, what do I need? What do I get the money? Then you now be looking at the financing decisions. The financing decisions issues that will be coming into your head is that, should I go to bank to borrow? Should I provide my own money? Should I go to friends to borrow? But we are doing this for large companies. So large companies, the investments, we are not going to be saying that this will be a working capital investment. It's actually going to be a long-term investment, and you have to use a long-term sources of finance. So you either be looking at equity or you either be looking at debts. Okay, if you are financing your decision mainly through equity, then you know that, okay, you don't have any interest to pay on this particular decision. So the profit that you are making, what portion should I give to shareholders? Because they are the only people that are providing the fund. Okay, so the financing decision will now impact your dividend decisions, and your return on the project also will give you an idea about the dividend policy that you are going to be adopting. If you are using debt, you have to know that you are going to be paying what? Interest before you now have the net residual value at the end of the year. So if you're making profit of 10,000, you are going to be paying interest because you're using debt. The interest will be paid out of profit, or interest will be settled out of profit. So what will be the remaining profit? If you are paying a higher interest, it means that the dividend payment will be very low. Your dividend policy will be very low, or will be unfavorable to the shareholders and favorable to the company. Okay. But a situation where you are not using debt, you cannot tell the shareholders that, okay, you are going to be paying a dividend payout ratio of 5%. For what? What are you settling out of the profit? You are using only equity. There is no interest that you are paying out of the profit. So why are you giving us that particular policy? So if you're using equity, it will have impact on your dividend decisions. What policy are you going to be using? What portion of the profit are you going to be using? Are you going to be paying as dividends? If you are using debt, it is also going to be impacting because part of the profit will be used to settle the interest on the debts. So the remaining one, what will be the decision? The return on the investment will also impact your dividend policy. How much are we getting? Are we getting a rich return on the investment? If we are getting a rich return, then it means that our dividend policy must also be adjusted. So there's a link between them. Investment decisions will give rise to the financing decisions, and the financing decision together with the dividend decisions, together with the investment decisions are going to be having effects on the dividend decisions. The dividend decision in some way is also going to be having some impact on the what? On the project. So if our dividend decision, our dividend policy currently is 40-60, now we want to what? Undertake this project. Will shareholders accept a reduction or a revised dividend policy? That might also affect the kind of investment that you are going to be undertaking. The shareholders are saying that their dividend payout ratio should be 40%. They're not going to be taking anything like that. So it means that you have to undertake investment that are going to be, whatever is going to happen, you'll still be getting a dividend payout ratio of 40%. So in one way or the other, they are all going to be having impacts, or they are all going to be affecting what the decisions that we are going to be making under each of them. All right. Any question about that? And I hope you appreciate the link between them. Differentiate between corporate ownership and corporate management. How does the separation of these present problems in corporate life? Corporate ownership and corporate management. What is the difference?
Corporate ownership is concerned with who owns the business.
Okay. Yes, Mike.
Yeah, so the corporate ownership represents a situation whereby individuals have a stake in the resources of the organization, or they have financial interest because they have invested their money in the company.
Okay. And corporate management.
Okay, so senior.
Yeah.
Corporate management deals with the running of an entity, running the day-to-day operations of an entity.
Okay.
Whereas corporate ownership is where individuals, groups, or corporations have shares in a company, but are not involved in the operational running of the company.
Okay. 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 So yeah, corporate ownership has to do with you having a shareholding in a particular company, or you being part of the owners of a company. So corporate ownership has to do with the right to the ownership of a particular entity. That's corporate ownership. The corporate body, the setup, you have a right to the ownership. You are part of the owners of that particular setup. That is about corporate ownership. So having a shareholding in a corporate entity, that is what we call the corporate ownership. Or you have also contributed to the what? To the ownership of that particular company. Please, preference shareholders are not owners. So those people are giving loans, or maybe they are giving funds for assistance. But those who are the legitimate owners through ownership, or through issue of shares, or through purchasing of what? Ordinary shares. Okay, that has to do with the what? The corporate ownership. But if you come to a corporate management, we are talking about those in charge of what? The day-to-day running of the corporate entity. And this is going to be the directors or the managers. All right. The question is, how does the ownership and management present problems in corporate life? This is always going to be in a large company. The separation of ownership from control present a problem in corporate life. The owners are going to be different. All right. So we are saying that from our basic definition over here, ownership, the owners are different from managers, isn't it? From what we have said right now, there's a difference, isn't it?
Yes.
Okay. So the question now is, what does the separation of these two? What does the separation of ownership and management, what does this present problems in corporate life? What do you think they are talking about?
Agency.
I think they're talking about the agency problem.
Okay. So how does this particular separation present problems in corporate life? They are just talking about how does a situation of what agency problem arise, or they are talking about situations that are given situations, or how does the agency problem arise? That is what they are talking about. Okay.
Is it the causes of agency problem?
It depends on how you are going to be presenting your answer. How does the separation of the two present a problem? How does the separation of the two? You can't just stand up and say, okay, separation of ownership from control. They are not asking you for the causes of agency problem. No. They are saying, how does the separation of ownership from control present problems in corporate life or in large companies? That's what they're asking. So you just demonstrate how the separation of ownership from control is going to be presenting problem. How do we tackle this question? How do we tackle this question?
How does the separation of this?
No, say, can I try?
No problem, Sina.
Okay. So the separation of corporate ownership and corporate management present problems in various ways, and it can clearly be defined by the agency theory, where one party over here, known as the management, acts on behalf of the shareholders, which is the owners of the company, and issues arises because of I think I can take it from the types of conflicts we spoke about, or the examples as the conflicts between their goals, and also the separation of ownership and control.
Yeah, that's all.
Okay, not that. So, with respect to conflict of goals, just as we said, the goal of the shareholders are not that of the management, whereas the management are sometimes interested in short-term decisions or short-term survival and growth. The corporate owners are interested in the long term of, and they are interested in the long term profit or survival. So this would cause a problem in a corporate life. And also asymmetry of information that may exist between the corporate ownership and then the corporate management. Because management are closer to the operations of the business, they would have more access to information than the corporate ownership, thereby causing problems in the corporate life.
Okay, and the access to that particular information, they will use it to their advantage. Okay, if you have access to information that you are using it to the advantage of the company and the owners as a whole, we don't have any problem there because there will not be any conflict because you are using the information very well. Okay. Yes, this is the reason why sometimes you have to write plenty because try to pick the point from where he was talking about the management being interested in the short term and those people are going to be interested. So for the first ones, for the starting, maybe he was just trying to gather momentum. Okay, so let's come to here. Okay, we are going to be having corporate ownership. What is the objective of these people? Owners, what is their objective?
Growth maximization.
Okay, to have a return on their investment, isn't it? What is the
Yes.
objective of the management?
Profit maximization, efficiency.
Okay, it's not necessarily profit maximization. If you are maximizing profits, the profit will go back to the owners in a form of return. Okay, but the issue is these two, I cannot maximize your wealth by taking a higher amount of salary. No. If I want to maximize your wealth, it means that if I want to maximize your wealth, it means that I have to make a sacrifices. So management, they are interested in what? In that status. They want to be seen as one of the important people in the society. So they want posh cars. They're interested in what? Salary increments. Okay. So management will be doing things that will what? That will gratify their interest as against the objective of the shareholders by getting a higher return on their investments. Management will be looking for ways that they can what? They can satisfy themselves. They can get their bonuses. So they'll be doing things that will satisfy their what? Their interest. And satisfying my interest, there is no way you are going to be what? You are going to be what? Benefiting. Because if I'm being paid a high amount of salary will be taken as an expense from our revenue. And that is going to be what? Reducing the earnings for the year. And if the earnings is very low, we need to return some of them to run the operations again. So management will be interested in, management will be interested in doing things that will satisfy them. They will be doing things to maximize their own status by taking a higher amount of salary, driving posh cars and all those things as against the objective of the shareholders who want to maximize their wealth through a higher return on their investments. So these are going to be having differences in objectives. They are going to be doing things that is going to be affecting the other. These two cannot happen. Management cannot satisfy their interest at the same time satisfying the interest of the shareholders. No, it can never happen. So they are going to be having two different goals. Their objectives are not going to be the same. They are going to be having different objectives. One of them should be to maximize their worth through getting a return in form of dividends. One of them will be increasing their status as managers in the company through higher salary and also higher bonus. And these two cannot be done at the same time. If you are doing one, it means that you have to sacrifice the other one. So this is how this will present problem. It will present problem because these two people are likely to have different objective. They are likely to have the same objective. Their objectives are going to be different. And if they are different, it means that they will be doing different things. So you can bring in those things that they'll be doing. Management will be interested in the short-term investments as compared to shareholders having long-term. Management will be willing to retain a lot of the profit so that they can increase the size of the company and get higher return. So with this particular introduction, you can bring in those issues that you think are likely to be to be the areas of conflict between these two. All right. Auntie Patricia, question number 2.
Question 2. In corporate finance, capital structure refers to the mix of various forms of external funds known as capital used to finance a business. It consists of shareholders' equity, debt, and preferred stock, and is detailed in the company's balance sheet. Required. Identify 4 determinants of capital structure.
Okay. So capital structure, we are just talking about the long-term structure of the company. So the long-term structure we are talking about, what we are talking about is that we want to talk about out of our total net assets, what portion is financed through equity and what portion is financed through other sources, which will be maybe preference shares, which will be maybe debentures and other sources. So we are talking about the structure of our long-term capital, which is going to be the shareholders fund plus the debt components or the debentures or the preference shareholders. Okay, we are talking about what are the things, what are the factors that can determine a capital structure of the company. What are the things that will determine the capital structure of the company? That's what we are talking about. What are the things that will tell the company that, okay, we need to have 35:65% capital structure. All right. So those are the things that we are talking about. What are the determinants?
The size of the company.
Okay, the first one will be the size of the company. Okay, the size of the company. So the size of the company is another factor. Size of the company. So the company that is very big cannot have only equity because most of your activities, the shareholders cannot be able to provide all the fund. So if you look at the size of the company, okay, you are just a startup company within a year, you want to have more debt than equity. Are you normal? No. The size of the company will also determine the capital structure. What again?
Management control.
Okay. Management control. Can you tell us what you mean by management control? Yes, please, can you help us with what you mean by management control?
So I don't know how to put it. I don't know how to put it.
Put it anyhow, we will get it.
Okay, so with the management control, like okay. How the entity or the company is controlled. Is the company control? No, say I can't.
Okay, yes, Nagapi, you want to bear her out.
Let me try.
Okay.
So the management control or management can be a determinant factor of capital structure. That is, you can say that it depends on the decision of the management, those controlling the management, either to go for debt or equity.
Okay. 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 That is cool. Auntie Patricia, is that what you want to say? Okay. So management control, yeah, that is well explained. Yeah. Okay. So for now, I can take your management control. Okay. Thank you, Senior. Yeah, what again? Please, can you hear me?
The availability of the source of capital.
Okay. So the availability of the funds also. So do you have the debt? Do you have the funds available? Okay, that can also determine. So if you have mostly if you have the cheap debt funds available, that can also determine that. So if the funds are available, now if you want to have debt now, are the debt available? If you want to have equity, if you want to issue shares, okay, is there any market for the shares? Which of these are available? So the availability of funds can also determine that. Okay, Auntie Patricia will be asking why am I explaining the point for the guys and I'm not explaining the point for the ladies. Okay, we are tired of hearing what man do man. Okay, so we want to be we want to support, we also want to do men empowerment, not only the women empowerment. Okay, let's what again? They are not anything. We can also look at the gearing level, the existing gearing level of the company. Okay, the existing gearing level. So what is the current capital structure of the entity? Okay, so you look at the gearing level, you can also say, okay, currently we are having 55% to 45. No, we cannot go for additional debt. No, because the debt is higher than the equity. So we have to go for we have to issue or we have to raise finances now for what equity means because we are already geared. So you can also look at the existing gearing level or the current gearing level of the entity, the current level, the gearing level of the entity. You can also look at the liquidity position of the entity. Okay, so you can also look at the liquidity position of the entity. Do we have cash? If we are going for debt right now, do we have funds to be able to pay the interest on them? So a company that is having a lot of cash, yes, a company that is having a lot of cash can decide to what? Go for what? Additional what? Debt because we have cash to settle our liability. We have a lot of cash to settle our liability. So we can also talk about the liquidity position. We can also talk about the tax benefits. Okay, the tax benefit on the tax implication or the tax benefits. Okay, the tax benefit or the tax implication. We know that dividend paid on equity shares are not tax deductible, but the interest that you are going to be paying on debt will be tax deductible. So if the tax rate is very high, what is the tax benefit? Right now, if the tax is 50%, like if you are paying tax of 50%, it means that if you are going for equity and you are paying dividend of 2,000, you are not going to be enjoying any tax benefit on the 2,000 dividend because the dividend will be paid out of profit. But if you are going for debt and the tax is 50%, if you are paying interest of 2,000, it means that you are going to be enjoying tax benefit of 1,000 on this. So in effect, you are only paying what? 1,000 as the interest because it's giving you a tax benefit of what? Of 1,000. So we can also look at the tax benefits associated with the sources. So the tax implication of that. There are a lot of them, but these are the ones that we can mention now. Okay, let's come to the B, then we pick some. Okay, we will finish right now. So we don't have a lot of things. Let's see whether within the next 1 hour we can finish because I have. Okay. Let's come to the B.
B. Short-term finance is usually needed for businesses to run their day-to-day operations, including payment of wages to employees, inventory ordering, and supplies. A range of short-term sources of finance are available to businesses. Required: explain the term pecking order theory. B. Explain why an entity might choose either bank overdraft or short-term loan to finance its day-to-day operations. C. Differentiate between scrip dividend and rights issue.
Okay. So they say that short-term finance is usually needed for business to run their day-to-day operations, including payment of wages to employees, inventory ordering, and supplies. Okay, a range of short-term sources of finance are available to businesses. Required: explain the term pecking order theory. in business finance. Explain why an entity might choose either bank overdraft or short-term loan to finance its day-to-day operations. Differentiate between scrip dividends and also what we call the right issue. What is a pecking order theory?
It's a theory which guides firms when they intend to source for finance.
Okay, that is not bad. Yes, Mike.
Okay, pecking order states the source. It basically states the sources of finance for company, which states that they should first look at their retained earnings. If they are looking for capital to inject capital in the business, they should first go through or look through the company's retained earnings before the next one, which is before looking at the rest. So that is debt and equity.
Okay, so
But the first one should be retained earnings.
okay.
Okay, so
yeah.
I want to add to it. So they first consider the retained earnings, then the next option they consider is the debt before they consider equity. As in,
yeah, but we have a lot of
issuing-
debt. We have a lot of debt. So the debts, they can use debentures, they can use loan, they can use convertible instrument, they can use maybe preference shares, or they can also use equity. Okay. So if you cannot list them, they say that they should look at their retained earnings first, then they look at the debt finances. If the debt finances are not cheaper, then if they are not available, then they can now utilize equity. Okay, so if you are not sure, you can just put all of them together. Yeah, Sina, you can finish now. Yeah, Sina, you were saying something, or you are done?
Yes, sir. I wanted to. He was unsure between the debt and the equity, which one should come. That's why I added to it.
Okay. That's fine. Okay. So Sinaibi, can you say what you have said first?
Said the theory. Hello.
Yeah, Sina, I'm with you.
The theory guide businesses when they intend to raise or source for funds.
Okay. All right. So the pecking order theory is a theory that serves as what? Guidelines, or that serves as a guidance for entities in a time that they want to raise forward. They want to raise what? Long-term what? Or they want to raise finances through long-term means. Okay. So this theory is going to guide you. This theory telling you that, okay, if you want to now finance a project from a long term, how should the sourcing be done? What is the first option for you? Okay, the theory says that if you want to go for long-term finance for a project, if you first look at what the retained earnings, because the retained earnings will come at no cost. So this theory is being propounded based on the cost of issuing. So retained earnings basically will come at no cost. You're not going to be incurring any issuing cost. So look at your retained earnings. If you're looking at your retained earnings, you're using your retained earnings, shareholders will not be getting additional dividend from whatever you are using. Okay, and you're not going to be paying anybody to go and sell the shares for you. So look at the retained earnings because it comes at no cost. Basically, it comes at no cost. If the retained earnings are not there, look at what? Debentures, or you can look at your loan stock. Okay, if the loan stock are not there, you can look at what? Maybe preference shares. If the preference shares are not there, you can look at your convertible instruments, or you can look at the convertible instrument before the preference shares. Then if these are not there, then you can just look at the equity. So this theory is giving us the sources based on the cost associated with what? Each of the sources. So retained earnings first. If the retained earnings are not there, if you cannot group them, please just say, okay, after retained earnings, if the retained earnings cannot finance the project, then you fall now on debt finance means. If the debt finance means are also not there, then you can now fall on what? Issuing additional shares to what? To finance the project. Issuing additional shares to finance the project. So that is a pecking order theory. It's a theory that guides what? Entity in a time of what? Sourcing for what? Long-term what? Finances. And the theory gives idea or suggests how the what? How funds should be raised whenever the entity wants to finance a project through a long-term sources of capital or sources of finance. Okay, let's come to the B part. Explain why an entity might choose either bank overdraft or short-term loan to finance its day-to-day operations. Okay. What are they asking here?
They're asking the difference between overdrafts and long-term debt.
The advantages of short-term financing.
It depends on, in the exam hall, it depends on understanding of everyone. Yeah, they say explain why an entity might choose either bank overdraft or short-term loan finance, short-term loan to finance its day-to-day operations. Okay, so the company can decide to choose bank overdraft and they will not choose a short-term, isn't it?
Yes.
Okay, they can also decide to choose the short-term and they will not choose the overdraft. Is that also the case?
Mm.
And they can also decide to use the two. Is that also the case?
Yes.
But
Senior, isn't an overdraft
a short-term
form of short-term? Yeah.
Okay.
So short-term, I'm seeing short-term to be, so for instance, if you're preparing an account, it falls under current liability. So short-term and overdraft will be under current liability. So I'm seeing all as
our problem is now about classification.
It's about the question.
Okay, our problem is now about the classification of these two. They are all current liabilities. Yeah, Senior.
I think the question says long-term loan and not a short-term loan, not short-term finance.
Okay.
But short-term finances.
Short-term loan
to finance.
and bank overdrafts. Are they the same?
No.
No, they are not the same.
So Senior, why are you saying that Senior Mike, why are you saying that you are seeing the two as the same?
Okay, so
No,
I'm seeing that the same as that. My understanding, as in the question is rather looking for advantages of short-term loan or short-term finance option. That's what I'm saying. In the context of this question, might be the same.
No, they are the question is actually demanding for advantages of bank overdraft. If you want to choose a bank overdraft, it will be based on the benefit that the bank overdraft will be giving to you, isn't it?
Yes.
Yeah, so that is the advantage or that is the benefit. If you also want to look at the short-term loan, it depends on the benefit that it will be given to you, isn't it?
Yes.
Yes, so the question is basically asking about why will you choose bank overdraft or short-term loan to finance its day-to-day operations? Why would a company either choose a bank overdraft or they will choose short-term loan? They're just talking about the advantages or the disadvantages of the two. How is it? Why would a company choose bank overdraft?
Senior, A company will choose bank overdraft because of the shorter period in paying interest.
Okay, that is no problem. That's no problem. If the okay, there will not be any problem because, but this will actually have the bank overdraft will actually have effect on the company operations, but they can also choose that because maybe they don't want the interest to accumulate for a longer period of time. Okay, so if the company, they don't want a higher interest to be paid because you know that a loan, they are going to be giving you a payment plan. So if it is for 30 days, the interest will be calculated for 30 days. But if you come to bank overdraft, the interest will be charged on the balances in the accounts. The interest will be charged on the balance in the account. So if you have paid this part of it, the interest will be charged on the remaining amount. But a short-term loan, it can be a simple interest. Whether you have paid a part of it, the interest will still be charged on the principal. So a company that is trying to reduce the interest payment or the interest expense might go for the bank overdraft. And the bank overdraft, you have to know that bank overdraft does not need any other issues as to guarantor and those things. It's a facility that will be granted to what? A current account holder of a company. So it's easily
So it is easier to get.
Yeah, it is easy
Yes.
to get. Nobody's going to be saying that, okay, go and bring a guarantor or anything. No. So it is easily accessible, or it is available to everybody. As soon as you are current account holder of that particular company, it is going to be given to you. Okay, bank overdraft might not necessarily bring in any cost. You might not incur any initial cost for bank overdraft. The facility has been given to you already. You can just go and withdraw. But for bank loan, you cannot process the what? The loan now. You can pay a loan processing fee. The short-term loan, you can pay a loan processing fee, which will be an additional cost to the loan that you are taking. So bank overdraft is likely to come at no cost. It's likely to come at no cost because you're an account holder of the entity already. There is no way they are going to process. The facility is granted to you as soon as you are current account holder. That facility is being granted to you. So there's no need for you to go and fill any form. Maybe you have filled this form the time that you are opening the account. So there's no need for you to pay loan processing fee or any other issues that will come with the loan itself. So a company that seeks to what? Maximize their interest payments will go for a bank overdraft. A company will go for a bank overdraft because of its availability. A company will go for a bank overdraft because of what? Because of the cost. Okay, if a company is going for bank overdraft now, what will make the company not to go for bank overdraft and they will now go for short-term loan? So you look at the benefit of you going for a short-term loan. Okay, the short-term loan comes with a payment plan. The short-term loan comes with a payment plan, but the bank overdraft does not come with a payment plan. As soon as the money hits your account, the deduction is automatic, quick loan. That's how the bank overdraft works. They are not going to be giving you, okay, pay this amount. No. As soon as the money hits your account, it's automatic. They will deduct it. But for short-term loan, there's a duration for it. There's a duration for payment. So there's a payment plan. Since there's a payment plan, the company will also be able to plan their cash. So a company that is having a cash problem will go for a short-term loan because we know that at the end of this month, we are paying 10 cedis. So any money that is coming, we can plan how we are going to be spending that money. But if you're having a cash problem and you are going for bank overdraft, as soon as the money hits your account, that is the end. You will not be having cash. So a company that is having a liquidity problem will go for a short-term loan. Or that is having a cash problem will go for a short-term loan. Or a company that uses cash in most of their activities will go for the short-term loan because that is going to give them a payment plan and they know how they are going to be managing their cash very well. So this company is actually talking about the reason why a company will go for a bank overdraft being the benefit of the bank overdraft, and the reason why the company will go for a short-term loan being the benefit or advantage of the short-term loan. Okay, differentiate between scrip dividend and right issue. what do we call a scrip dividend?
Yes, sir.
Yes, Mia.
Yeah, please, I want to find out the interest charged on overdraft and then that of the loan. Which one is higher?
It depends on the volume of the transaction.
Okay.
Okay, so then can you add that a short-term loan has a fixed interest payment, but then overdraft fluctuates depending on the transaction?
Okay, the interest payments the interest that you are going to be paying, it cannot be a major factor because you can just go for a loan and they will give you a lower interest rate. Okay, and you can also go for overdrafts where the interest will be charged on the balance in the account. Okay, so you can see that the overdraft will always come with a lower interest because if you are able to pay, if you have taken 12,000, you're able to pay 10,000, they will charge the interest on what? On only the 2,000 remaining. But if you are taking a short-term loan, whether you pay 5,000 of the amount, the agreed amount was on the principal. So we still charge on the 12,000. But at this particular interest, they can give you an interest at a lower rate, which at the end of the day, the bank overdraft might even be higher than that particular interest that you are paying on the principal because of how cheap the loan is. So the interest might not be a major factor. Okay, but it depends on the volume of the transaction. Okay, it depends on the volume of the transaction. The interest, all things being equal, it depends on the volume of the transaction. You might be having overdraft and be paying higher interest, and you might also be having a short-term loan and be paying a lower interest. Okay, so the interest should not be a major factor unless you are being provided with maybe some figures that you can now do the calculation and now say that, okay, the company should go for this one by looking at the interest that we are paying on the overdraft and the interest that we are also paying on the short-term loan. Okay. Scrip dividends and right issue. Scrip dividends, right issue. I hope we have, yeah, Senior. Manuel.
Yes, the scrip dividend is the payment of dividend in the form of new shares. So instead of paying cash to shareholders, we rather give them shares as their dividend. Then the right issue is the right given to shareholders to subscribe to newly issued shares in proportion to their current share holdings.
At a lower price.
Yes, at a lower price.
All right. Yeah, Senior, thank you. Yes. Now, Michael, your hand is up.
Wait, me and I. Okay, then let me talk. It's an old one, but so scrip dividend is a dividend policy where if the company doesn't have enough cash to pay, they pay through increasing the existing shareholders their shares. And so that's a dividend policy, and right issue is a source of raising finance by giving existing shareholders the opportunity to buy new shares at a lower cost.
Okay. Do we have anyone before I will see what I want to see? Okay. The issue of scrip dividend is using shares to pay dividends. Okay, the scrip dividends. Okay, you know that if you declare dividends, you have to pay cash to the people. You have to pay the dividends in cash. But what companies do is that since we don't have cash, we will now issue shares in what? In payment or in return for the dividend that has been declared. So using shares to pay dividends. So instead of you giving, you have declared a dividend of 20,000. Instead of you paying cash of 20,000, you will now issue shares up to the value of 20,000 to the shareholders. That's what we call the scrip dividends. Okay. The right issue is the issue of new shares, but these new shares will be issued to the what? To the existing shareholders in the proportion of their ownership at a discounted what? Price. So you give them the option. Okay, it's an option for them to what? So you are giving them the option because they have, what are they calling their rights? Because they are the owner of a company, so they have a right. So you now give them the right, the option to exercise the right. If they are not, then you now send it to what? To outsiders to buy. So the right issue is the issuing of new shares to the existing shareholders in the proportion of their ownership, which is always going to be at a discounted price, which we call the offer price. Okay, that is what we call the right issue. Why are we giving the shareholders this? Because they have a right that we call okay, the okay. So they have a right that we call preemptive rights. So is the existing shareholders have a right that we call preemptive right. What do we call preemptive rights? So the privilege that they are going to be having as a result of them being issued the right issue, them being the subscriber of the right issue or the new shares before the what? The outsider. So that privilege that they are going to be enjoying, the opportunity that the right issue, the shares will first be issued to them. Those that are not able to subscribe or those unsubscribed shares will not be issued to the public. So that right of the share being issued to the shareholders first before any other person is what we call the preemptive right. Okay, why would a company be using a right issue? We are going to be looking at that under a question over there. Okay, so that is how we call the right issue. Issuing of a new shares to the existing shareholders in proportion of their ownership at a price that will be lower than the actual market price of the shares. And a right issue will always bring in an issue that we call we are going to be looking at that. The right issue will always be done at a discount, and that is going to be affecting the share price after the right issue. And we'll be looking at that very soon. Question number 3.
Question 3. Examine 2 ethical issues that need to be adhered to in the marketing of Islamic products and services.
Okay. So this is Islamic financing. Please learn about their products. Those Mundaraba, Musharaka, and Co. Okay. Read about them. They haven't examined that from the start of this one. So anything can happen. Go and read about them. So let's come to examine 2 ethical issues that need to be adhered to in the marketing of Islamic products and services. Okay. What are the issues that must be what? That must be prohibited when you come to what? The Islamic finance. What is the first prohibition? What is the first haram? Yes, Neemano.
The riba or riba. The riba.
Okay, what is riba? Yeah, I'm not.
Yeah, that's the they say that it's forbidden to use money for the purpose of making another money.
Okay.
Example, like charging interest.
Okay. The riba is interest. Okay. The riba is actually interest. Okay. So, okay. So the first thing is that you should avoid charging what? Interest. Okay. The reason is that you are using money to make what? Money. You are using your brother to make money. No. Or they are saying that all benefit or all gain must be generated through asset means. Okay. So if you are marketing Islamic product, you should avoid the issue of what? Charging interest. The items or the product that you are going to be issuing should be free of what? Interest. Whatever is going to be happening over there, you should not have the intentions of what? Making money out of whatever you are using. So you should avoid of adding interest, charging interest on whatever product or service that you are going to be offering. Interest element should not be part of it. So avoid charging interest. Okay. You should also avoid what? Marketing what? Products that are based on speculations. Products are based on speculations, or product that their subject matter is not what? It's not known. Okay. If you're also issuing a product, the product should offer a higher benefit, social benefit to the public than yourself. The product should be in what? Asset form. It should be in an asset form. Wealth should be generated through what? Capital assets. So you should only market what? Capital items or capital products, Islamic products that are of capital nature. So charging of interest, you should not charge interest, is prohibited. You should not market products that are based on speculations. The product that you are marketing should have a greater impact on the society than yourself. The product should give a greater impact to the society than yourself. Okay, so you can also write this question based on the prohibitions under the what? Under the Islamic financing. Those prohibitions are ethical issues. If you are not able to adhere to that, it means that you are doing the wrong thing. So a situation where you are doing the wrong thing, we are bringing about what? Ethical situations. So what are those situations that are going to be making the person to do a wrong thing? Those are the things that we are talking about as ethical issues. What are those behavior that can be questioned? Those are the ethical issues that we are talking about. So charging of interest should not be what? The instrument that you are going to be marketing should be devoid of what? Any interest elements. The instrument should be of capital nature. The instrument should not be on speculations. The subject matter of whatever product that you are marketing should be known. It's not that, okay, if you bring 10 cedis, there is something right now, if you bring 10 cedis, you are going to be getting 20 cedis. This is based on speculations. And the instrument should not be instrument that we can classify as what? Gambling. No. All right, so you can answer this question based on the prohibitions under the Islamic finance. Okay. B.
B. The managing directors of 3 profitable listed companies summarized their company's dividend policy as follows. Company A has deliberately paid no dividend for the last 5 years. Company B always pays a low dividend per share after adjusting for general price index and offer regular bonus issues. Company C always pays dividend of 5% of earnings after taxation. Each managing director is convinced that his company dividend policy is maximizing shareholders' wealth. Required. Identify the dividend theory applied by each of the 3 companies.
Okay, so we have the dividend policies, and that is not that much. The dividend policies, you look at the 3 of them. Then we also look at factors that can place restrictions on dividend. We say it can be government can say companies should not pay dividend about this one. So it can be legislations passed by the government. Those are the restrictions. It can be maybe a debt covenant, or maybe management can decide not to pay. There are a lot of issues. Maybe the liquidity problem, the liquidity position of the entity can also, so you can also read about those restrictions on the dividend policy. Let's come here. How many dividend policies do we have? The theories. How many do we have? Dividend theories. Okay,
3.
namely we have what?
Dividend irrelevance theory.
Okay.
Irrelevancy theory.
Okay.
The
Irrelevance
time
theory and
residual
The
theory.
signal explanation.
Okay. So we also have the residual theory. We have the dividend irrelevance theory. I also have the dividend relevance theory. Let's relate these three theories to these three situations. The company A has deliberately paid no dividend for the last 5 years. Which type of dividend theory are they using?
Irrelevant.
Okay. So the irrelevance is a situation where the shareholders, they don't see the dividend as a way of what? Maximizing their wealth. So they don't care about dividend payments. They care about, if you want to maximize your wealth, you can sell your shares and get a gain over there. So they don't care about what? About the dividends. So as far as you are going to be returning the dividend that will give them a higher return, they are okay. So the company is using irrelevance theory for the first situation. Okay, so the company A is using what we call the irrelevance theory, which states that shareholders' wealth is not maximized. The shareholders believe that their wealth is not maximized by what? The return that they get, because the return is going to be a small amount of money. So as soon as you can use the return or the money to do other projects that in the long run is going to give them return, they are okay with it. So with this particular theory, the company can decide not to pay a dividend because the shareholders are not going to be saying anything. Let's come here. Company B always pay a low dividend per share after adjusting for general price index and offer regular bonus issues.
Residual.
This is what?
Dividend relevance.
Residual.
The residual.
Okay, this is residual. Why?
They pay after adjusting for the general price.
Okay, the residual is saying that. Okay, the residual is saying that. Okay, the residual theory is saying that. Okay,
Residual.
if you have a profitable investment or anything that you are going to be happy, use the money for that particular thing first. Okay, if there is any amount remaining, then you can now decide to declare portion of that particular amount for as a dividend. Okay, so they believe that, okay, you can undertake the project. We don't believe that the dividend, but we also need small amount of the dividends. So whatever amount that you have, use it for whatever you are going to be doing. So pay the adjusted. After you have adjusted or after you have taken a portion of that for a purpose, then you can now declare the remaining amount of the earnings, part of it or all of them as what? As the dividend for us. So if you are going to be paying us 100 cedis and you want to undertake a project of 70, okay, just undertake the project. Since the project is going to be giving us a return, a positive return at the end of the day, you can now give us the 30 cedis as what? As dividend. That is a residual theory. So this particular one, the company is using residual theory. Let's come to company C. Company C always pay a dividend of 5% of earnings after taxation. Which one is this one?
Dividend relevance.
Relevance.
Okay, this is relevance. Whether the dividend is low or not, give it to us. We don't care. The dividend payment of the company to these people, to this school of thought, they believe that a dividend payment is a sign of the company doing well. It's a sign of the company what? Doing well. So if you're not paying dividends, it means that you're not doing well. So our investment will be lost. So they use a dividend as a performance measure for the company. So if you are paying dividend, it means that you are doing well. If you're not paying dividend, it means that you are not doing well. So what do we have to do? So this is about the dividend relevance theory. So this theory is about dividends. That is a dividend relevance theory. Let's look at question number 4 and question number 5. Then we see what will happen. Question number 4 is about capital structure. Okay, let's take that.
Question 4. DL Ghana Limited is a medium-sized company in the manufacturing industry. The company is considering an investment of 10 million cedis. It has two options of financing this investment. One would be to borrow from the bank for 2 years at 10% per annum. The other would be by means of a 1-for-4 rights issue. The finance director, who is responsible for both financial control and treasury functions, is concerned with the company's level of financial gearing, industry average gearing, prior charge capital over total capital employed is currently 50%. He has asked you to review the company's most recent financial statements. Required. A, calculate the financial gearing ratio of the company under each of the three scenarios provided below. A, the company does not take up the investment. B, the company finances the investment by means of borrowing. The company finances the investment by means of rights issue.
Okay.
And then the second requirement, recommend for the company of a proposed course of action based on your calculations.
Okay. So this is about capital structure, which is basically talking about which is basically talking about financial gearing. Capital structure, we are talking about the structure of the organization in terms of long term. So we can use operating gearing. Operating gearing has to do with the component of the fiscal that the entity is having. So we can use operating gearing and financial gearing. And this is about the financial gearing. They are saying that the company wants to undertake an investment, and investment is 10 million. Okay, industry average gearing, which is proud charge capital or total capital employed, is currently 50%. He has asked you to review the company's most recent financial statements. The question now is, what do we call the proud charge capital? What is a proud charge capital? Proud charge capital. Okay, proud charge capital is just like a long-term what? A long-term debt. Okay, a long-term debt that carries what? A fixed charge. So preference shares, debentures, bank overdrafts, which are going to be classified as any interest-bearing item or any interest-bearing what? Instrument that is classified as a long-term debt or a non-current liability. That is what we call a proud charge capital. So in this case, there are only two. We have the debentures and bank loans. Maybe the question should classify these loans and the bank overdrafts as a non-current liability. They'll be part of what? The proud charge capital. So the proud charge capital is basically the what? The long-term debt. Okay. Let's come here. The question is asking us to do three things. Okay. Please, your financial gearing should be what? The industry average is what? Is 50%. Okay. So let's see what we are having. If you have the gearing should be 50%, that is the industry average. If you're having more than this, it's likely that you'll be out of business. Okay. So let's come to what they are asking us to do. Okay. They are saying that I should calculate this, that the company does not take up the investments. If the company does not take up investment, it means that there will not be any 10 million coming in. Okay. So if the investment is not what? It's not undertaken, what will be our proud charge capital? What will be our total proud charge capital? If the investment is not taken, if the investment
17,300
does not take up the investments. So you calculate your proud charge capital. Okay, you calculate your proud charge capital. Okay, the proud charge capital is just a non-current was interest-bearing items there. So we have debentures. How much is the debentures?
15,900.
Okay, so we have 15,900. The bank loan is how much?
1,400.
Okay. The total will give us what?
17,300.
17,300. So we need to calculate our capital employed. Our capital employed is just the total asset minus what? Total current liabilities, which is also calculated as the shareholders fund plus the
The
long
long
term. Okay. So you have
interest-bearing debt.
so you have the stated capital there. What is the stated capital for them?
5,500.
Okay. What is their retained earnings, which we call the accumulated profit over there?
7,200.
7,200. Then we now add the proud charge capital to have the capital employed.
They also have share premium.
Is there share premium is there?
Yes.
Okay. Sorry. Preference shares will be part of the non-current, the prior year charge. Okay. Preference shares to be part. Okay. So we have the preference shares here. How much is the preference shares?
2,500.
2,500. So what will be the total?
19,800.
19,800. So the proud charge capital will be 19,800. What is the share premium?
Share premium is 1,800.
So we have share premium of 1,800. What will be the total? With 34.
34,300.
Okay. So let's calculate our financial gearing now. So our financial gearing. Financial gearing.
57.73.
Financial gearing will be 19,800 divided by 34,300. Currently, we are having 57.
73.
Okay. Percent. Okay. Let's count to the second one. What is the second one?
The company financed the investment by means of borrowing.
Okay. So if you are now financing by means of borrowing, what will happen? It means that what are we having here? How much are we using for the investment?
10 million.
Okay. So it means that our long-term debt will increase by 10 million and our capital employed will also increase by 10 million, isn't it? Okay.
Yeah.
Sometimes they will give you profits and they will ask you for the impact on the profits. You see that this particular 10 million will be coming with interest. But this one we are not giving the okay, they are giving you the interest of 10%. Okay. So sometimes they will tell you that what will be the impact of this on our profits. Okay, you are going to be paying 1 million interest at the end of every year. So they will ask you to calculate the profits now and then maybe after the investment, what will be the profit? So you have to show that. But right now we don't have access to all those information. So we are going to be working with only the 10 million. Don't include the interest as the company will pay the interest out of the bank. No. We are just saying that this is going to increase by the 10 million. Okay. So the 10 million is going to increase our proud charge capital and our capital employed will also increase by 10 million. So that will be the increments. Okay. So that will be increment in assets because we are going to be receiving that as cash and our liability will also be increasing. So the company investments is through borrowing. Okay. So through borrowing, our proud charge capital will now be calculated as the existing capital, which will give us 19,800 plus the debt that is coming, the loan that is coming in, isn't it? The loan that will now give us 10,000. Would that be 29,800?
So are they hanging zeros on top?
I'm sure. But if there are no zeros, you can just do no. So you can just leave it like that. If there's no zeros, just look at it and do your work. So there are no zeros there. Okay. So we come to our capital employed. Our capital employed will be the existing figure, existing amount to be 34,300. Then the loan now increase by 10,000. That will give us 44,300. So let's calculate our financial.
Hello, sir. Hello, sir.
Yes, please.
Please, can you go back to the previous slide? I want to ask a question there. Yes. So we are calculating for the second option where we are financing by borrowing.
Yeah.
But I can see that we did existing capital, which is 19,800.
No problem. Without the
Yes,
borrowing, without the borrowing, this is our, without doing anything, this is our existing amount now. Without undertaking the investment, this is 19,800. But if you want to undertake the investment, now you're not going to be borrowing again. It means that your existing capital will be increasing by 10 million.
okay.
I can move on now.
Yes, please.
Okay. So
67.27.
Our financial gearing will be equal to 34,300 divided by 44,300.
It's 29,800.
29,800 multiplied by 100. What are we having?
67.27.
67.27. Okay, let's come to the last option, which will be, it will be issued through a right issue. Okay, if it is a right issue, what will happen? What will increase? If it is
Number of shares.
Number of shares.
okay, the equity value will increase. So our prior year charge will still be the same as 19,800. Okay, so let's calculate. We don't have to do that again. So we know that financial gearing will now be, okay, this will still be 19,800 because there's no going to be any increment in our existing borrowing. But our capital employed or the equity portion will increase by the 10 million. So this will now be 19,800 divided by 44,100 multiplied by 100. What are we getting?
Sir,
Yeah.
why are you maintaining the 44,300? Because the next option is by means of right issue.
Okay. What is the right issue?
It is where there is option that is given to the share, the existing shareholders of the company.
Okay. So if the option is given to them, what would they do?
The company is considered an investment of 10 million. Okay.
Forget about the point. What would they do? Forget about the reading. What would they do for the 10 million?
It will be added to their
They are what?
They'll provide the 10 million to the company.
So, maybe don't intervene. Okay. Sina Benjamin, we are
So
together.
I don't understand.
When the right issue is done, what would the shareholders be doing? If the shares are given to them, would they buy?
Yes.
So if they buy, what will happen? What will be the entries?
It will increase their number of shareholdings in the company.
Okay, what is the existing shareholding we have now? What is the value of the shareholders fund?
It's 5,500.
Shareholders fund.
Okay. The shareholder fund to be. It was 34,300.
No, that is capital employed, including.
Okay. It was the 7,200 plus the 1,800 plus the 5,500.
Okay.
Yeah.
That was
Yes.
how much?
5,500 plus 1,800 plus 7,200. That's 14,500.
Okay. Right now, if they are bringing a 10 million, it will be how much?
It will be 24,500.
We are looking for capital employed. What do? We add the long-term debt, isn't it?
So the 10 million, is it okay? The 10 million that is not about the total figure, it's about the 10 million that I don't understand. That's why you adding the 10 million to their shareholders list. Okay, but I've now gotten it now. Thank you.
Thank you too. What is the figure there? What's it for?
44.70.
Okay, after the decimal, we don't mention it like is
70.
Okay. So what are you going to be doing? What will be the option? Among the three options, what should they do?
They will take the means of right issue.
Okay. So the share should be issued through a right. They should invest, or they should carry out the investment through a right issue. That's what they're asking you to do here. Okay. Let's come to question number 5, which is about the right issue itself. And let's see how we can go about it.
Question 5. Market Limited is considering raising funds for an expansion program through a rights issue. The expansion program is expected to cost 20 million Ghana cedis. The company has currently issued 2,400,000 ordinary shares, which are currently selling for 30 Ghana cedis each. The board of directors have proposed an offer price of 25 cedis per share. The fund to be raised will be invested in a project which is expected to generate net operating cash flow of 6 million each year over the project's useful life of 5 years. The salvage value of the project after 5 years is estimated at 5 million Ghana cedis. The cost of capital for the firm is 12% per annum. Required. A. Number of shares required to buy one new ordinary share. Number of rights required to buy one new ordinary share. B. Theoretical ex-right market price per share. C. Theoretical value of each right. D. Evaluate the impact of the right issue on the value of wealth of an existing shareholder who owns 1,200 ordinary shares in the company and 15,000 Ghana cedis in his savings account under the various options available to him.
Okay. Okay. So thank you. So how much are we raising? How much are we raising through the right issue? How much is the company raising through the right issue? How much are they raising?
6 million.
No, please.
20 million.
20.
The company is raising what?
20
20
million.
million. Okay. They say they want to raise this amount through a right issue, isn't it? All right. What is the right issue price? What is the right issue price?
25 cedis per share.
25.
The right issue price is
20
the offer. Is the offer price. Right issue price is the offer price per share. Okay. Marker Limited is considering raising funds for an expansion program through a right issue. The expansion program is expected to cost 20 million. They want to finance the expansion program through a right issue, and the program will cost 20 million. So it means that we have to raise what 20 million through the right issue. Okay. The company has currently issued 2.4 million ordinary shares, which are currently selling for 30 million. These are the existing shares, 30 cedis each. Okay. The board of directors has proposed an offer price of 25 per share. So the offer price is the what? Is the right issue price. Okay. We are getting how much? We want to get what? We want to get 20 million Ghana cedis, isn't it? By issuing a certain number of shares at 25. Okay. So how many shares do we have to issue? We are looking for a certain number of shares at 25 so that we can get 20 million as the total amount. The number of shares that will be issued.
800,000.
That will be 800,000, isn't it?
Yes.
Okay. That will be 800,000. So we need to, for us to find the number of rights required to buy new shares, we need to find the right issue. We need to find the right issue. How do we find the right issue? So let's find the number of shares under the right issue. So the number of shares under the right issue will be the amount that we are raising. Okay, so you can amount that we are raising divided by the value per share. How much are we getting?
0.8.
0.8 million, isn't it?
Yes.
Yes.
So
10 million
0.8
shares.
million shares. Okay, the shares that we are going to be issuing through the right issue is what? Is 0.8 million shares. But what is the number of existing shares?
2.4 million.
Okay, number of existing shares is 2.4 million. Okay, the question is, okay, how many times can the 0.8 go to 2.4? Or how many shares of existing shares are you bringing for one new?
3.
Okay, you are bringing 3, isn't it?
Yeah.
Yes.
Okay, so the number of rights for a new share, the number of rights for a new share is
1 for 3.
2.4 divided by 0.8. So you bring 3 shares for 1 word or 3 rights. So if you have 3 new shares, you have a right of if you have 3 new shares, that particular 3 existing shares will give you 1 new share. So 3 rights will give you 1 new share. Okay, so we are buying, you bring 3 rights, which is the existing shares. The right is the existing shares. If you are not an owner, you cannot subscribe to the right issue. So you having the existing shares is the right that you have. So the existing shares is that. So 3 right for what? 1 new under the right issue. So you are bringing 3 right for what? 1 new issue. That is under that particular one there. Okay. The theoretical XY price is just the price after the right issue. We are going to be calculating this in 2 ways, as you know. We use the total approach and then the unit approach. The one that is comfortable with you, you go with it. We are all comfortable. Okay. The theoretical XY price. The theoretical XY price is the price of the shares after the right issue. So this is how we are going to be determining the price of the shares after the right issue. This is going to be very simple. Okay. I hope we can determine that simple. Currently, what is the value of the shares? What is the total value? What is the total value? What is the total equity value currently?
7.2.
That is 72 million, isn't it?
Yeah,
Yes.
72 million. Sorry, 72.
Okay. Currently, 72 million. Okay.
72.
Okay. So this 72, what will add to it? You will now have 20 million from the right issue, isn't it?
Yes.
Yes.
Okay. So your number of shares will now increase by, you have existing of 2.5, and this will now be 0.8, isn't it?
Yes.
So what will now be your value per share now? That's what we call the theoretical extra price. I'm having 28.75.
Yeah, 28.75.
So let's calculate that. So first of all, you have to know your total number of shares after the right issue. So your existing shares are currently trading. Your currently the value of your shares is 2.4 multiplied by the value of a share, which is 30. So you'll be having 72. Okay, but the right issue, if you have the right issue will bring additional money of 20, which will be increasing your capital. So you will now be having, you'll be issuing 0.8 million shares
25.
at 25. Okay, and that will give us 20 million, isn't it? Okay.
Yes.
The total value of the equity now will be the existing one that we have plus the right issue. That will give you 92.
92.
Okay. And our number of shares will now be the 2.4 multiplied by this. That will be 3.2. Is that correct?
3.2.
Okay.
Yes.
So we know that 3.2 shares is giving us what? 92. So what will be the price per share? How much should we issue the shares to get the 92? How much should 3.2 million shares be issued to get a 92? That's what we call a theoretical extra price.
Extra price.
You look at your theoretical extra price is the price of the shares after the right issue. So that will give you the 92 million Ghana cedis divided by 3.2 shares. And that will give us
1.75 per share.
0.75 per share. Okay. So that is the theoretical, that is on unit, that is on total approach. Let's try, please, why am I doing all the two? Because you can have a question where you not have information on the unit and they will give you only total values. Okay. So you have to use, so they can give you a question here without telling you, they can give you a question here without telling you, you should find a number of rights. Okay. So you can just go ahead to do it on the total approach without finding the number of rights. But since we have a number of rights, it means that we can use it. We are bringing 3 for 1, isn't it? Bring 3 of your existing shares for 1 new shares. Is that correct?
Yes.
Which is the same as 1 for 3, isn't it?
1 for 3.
Okay. So we bring our existing shares. So how many rights are we bringing? We are bringing 3 at 30 what? Cedis. And this will give us 90. Okay.
9.
We are coming for a new share of 1. So you bring 3 for 1. Okay. And that one is valued at 25. Okay. So we have 25 here. So on the unit level, we are going to be having 115. And on this one level, our shares will now be 4. Okay. So the question now is, what will be our theoretical extra price?
28.75.
Okay. So that will give us theoretical extra price. Okay. That will now give us
115
divided by 4. That should give us 28.75. So any of them that you are using, that is fine. Okay, that is fine. So if you are looking for it at the unit level, that is it. If you are looking for at the total level, that is the first one. What are they asking us now? They say we should find value of what?
Theoretical value of each right.
Okay. Value of a right. Who is that? So, okay. So they are talking about value of a right. So the value of a right is just this one. Okay. Value of a right is just this. Okay. What is the new price of the shares?
25
No.
No,
28.
or 20 million.
28.
8.75.
Okay.
Okay. 28.75, isn't it? Okay. Assuming you want to sell the right that you have exercised. The exercise right will be the right issue that you are buying. You are not going to be selling your existing shares. Okay, you still want to maintain your existing shares, but you want to sell the right that you have exercised. Okay, the right that you have exercised is now valued at 28.75, but you have purchased this particular right at 25. How much are you going to be getting from the sale as a profit?
75%.
Okay, so that is what we call the value of a right, which is calculated as a theoretical extra price. Theoretical extra price minus the offer price. Okay, minus the offer price. Okay, so you are buying a right, you are exercising the right, and the purchase price of the shares that you are buying, exercising your right is 25. But now your right is valued at 28.75. If you want to sell it, you sell it to somebody at 28.75. But you have purchased this particular item 25. It means that I'm going to be making a gain of 3.75. That's what we call the value of a right. So you'll be having 3.75 per share. That is per share. You are selling, if you are selling a right, it's per share. That is a 3.75. What are they asking us now? What are they asking us now? Evaluate the impact of the right issue on the value of worth of an existing shareholder who owns 1,200 ordinary shares in the company and 15,000 in his savings account under the various options available to him. Whenever there is a right issue, what are the various options available?
Can choose to
Can do nothing.
can do nothing. Can
Exercise
choose
option.
help us and then keep some.
Okay.
Or exercise part.
Okay, so let's look at all those issues and so that first one, let's look at the D. Does nothing, isn't it? Okay. If the person does nothing, okay. If the person does nothing, let's look at the effect before and after. Before. So the person does nothing, the shares before the right issue will be 1,200 multiplied by what? 30, is that correct? Would that be correct?
36,000.
Okay, that will be
Yeah,
36,000. Okay. And the savings, the money that he has in the bank account will be what? Will still be 15,000, isn't it?
50,000.
Okay.
Yes.
Nothing will be happening to that. Okay, and the total money for the person.
51.
Okay, 51,000. Okay. Let's count to where the person will exercise their right. He will not sell any of them. Okay. So let's come to option. Let's come to after. This is before, after. Let's do the after before. So after the right issue, the existing shares will now be, the existing shares will still be 1,200, but this will be valued at what?
28.5, 28.75.
Okay, 20, no, After.
Okay.
After the right issue, it will be 28.75. What are we having?
$34,500.
34,500. And his savings will still be what? 15,000, isn't it?
Yeah.
So how much will be that?
49,500.
Okay. So if the person does nothing, the share value will reduce from 36,000 to 34,500. He will be losing 1,500. Let's come to where the person exercises the rights. Okay, sorry. If the person does nothing, what will happen is that you see if the person does nothing, the return, you can see that the investment will be what? Will be giving the return, and the return will be shared among all the shareholders. So let's look at their portion of the return also. So can we calculate the present value of the cash flow? So let me have a space here so that we can capture the share of the return also here. Okay, they have to have the share of the investment return that should have, because the investment is going to bring in a cash flow. Let's look at that. So let me see if this place will be enough for all of them. Okay, let me see whether this place can be, the space left can be enough. Okay, let's look at the NPV, the present value of the cash flows. Okay, what is the question that they are, what is the, okay, the funds to be raised will be invested in a project which is expected to generate net operating cash flow of 6 million each year over the project's useful life of 5 years. Okay, the salvage value of the project after 5 years is estimated at 5 million. The cost of capital for the firm is what? 12%. You are giving a net cash flow already. Net cash flow, net operating cash flow. So we don't have any issue of tax. So we see that that is after tax cash flow. So let's have our years here, our cash flow here, our discount factor here, and our present value. The discount factor is 12%. Okay, our cash flow is 6 million each year for 5 years. So annuity can be 1 to 5. So let's find, that is the net cash flows. Can we have year 0 to have the investment amount? So maybe the residual value, which is the return on the project, will now be disbursed against the amount then. So that will be this. Then we have 20. Okay, we have year 1 to year 5. That will be 6 million. What will be the annuity? 12%. 5 years.
3.605.
Okay, 3.605. Okay, so let's count to the fifth year. What will happen? They will sell the equipment for 5 million. Is that correct?
Mm-hmm.
Okay. How much are they going to be? What will be the discount factor?
You see? 0.567.
567. Okay, I'm having this one to be 21.63. What will be the last
Oh,
one?
that's correct. 21.63. Okay.
Okay. I'm having
2.835.
Okay, what will be the net present value?
$4.465.
4.465. Okay, so this is the return on the investment. Okay, this is the return on the investment. But if the person does nothing, what will happen is that, you see, if the person does nothing, before there will not be any return because the project has not been undertaken. So there will not be any return on this one. Are we okay? Before, there was no project, so this will still be 51,000. Okay. After the project has been undertaken, the existing shares for him, the existing shares will be 1,200 at 28.75. That will give us 34,500. Okay. And the savings in his account will still be 15,000. But his share of the NPV, the return, his share of the return on the project. So return on the project, let's look at the return on the project there. Okay, the project will be undertaken after the rights issue. So he's having only 1,200 ordinary shares. Okay, but if the rights issue is now done, what will be the total number of shares? Let's take his share of that. That will be 1,200 divided by how much? 32 million. Is that correct? After the rights issue, the total number of shares is 32 million.
Yes.
Okay. So you'll be having 1,200 divided by 32 million. The 32 million, the return will be shared among all the shareholders in the proportion of their shareholding. So we have 1,200 divided by 32 million multiplied by this figure. Let's change it to, since we are having all of them in the whole figure, let's change the return also to, so this is 4.6 million. Let's change it to the actual figure, 4.465 multiplied by million. I'm having 446,000, 4,465,000. Is that correct?
Yeah.
Okay. So how much will be the share of his portion there?
167.4544.
Okay. So let's check. 465,000. Okay, I'm having 167. Okay.
Yes, 0.44.
So 167.44. What will be his total amount? I'm having
49667.
Okay. So let's come to, he exercised the option. He exercised the option means that he has taken up the option. Exercise the right or the option. So let's do existing and also, so the existing before, let's make it before will be, before is going to be the existing, which is going to be 1,200 multiplied by the 30. That will still be 36,000. So the money in his savings account will be 15,000. That is before. This will now be 51,000. Okay, let's come to after. Okay, after we now have existing to be.
Senior.
Yes, please.
Okay, so please, sorry for taking you back. The return for the not exercising, is it 1,002 over 3.2 million or 32 million?
32 million. Is it 32 or 3.2? It's supposed to be 3.
That is 2.4 plus 0.8, so it's supposed to be 3.2.
Okay, okay. So 3.2.
multiplied by 4.465, right?
Yeah, the total answer should be what?
1674.4.
Okay. 1674.4.
4.4.
Okay.
Yes.
So that will give us how much?
Yes. That will give us 51174.4.
51174.4. Okay.
Yes.
If you are not exercising, the return is going to increase your distance small. Okay. But let's come to the existing. The existing will now be what? The existing will be the 1,200 at 28.75, isn't it?
Yes.
Okay. And that will give us how much? 34,000.
That's 3. Yeah.
Okay. Then the rights issue. The rights issue now will be, how many shares is he going to be buying under the rights issue?
3 for 1. So that would be
400.
400.
Okay.
400.
And this 400 will be valued at what? 28.75, isn't it? I'm having 11,100. Is that correct?
Yes, please.
11,500. Yes.
Okay. What will be the amount in the savings account? Please take your time before you mention.
Thousand one. Hey, that would be 3,500.
Okay. How did you get a 3,500?
He has bought new shares to the tune of 11,500. So you subtract from the 15,000.
Oh, the shares that he bought is at 25. The issues are 25.
25.
Yeah.
Okay. So then, if it's at 25, why are we maintain the 28.75 here?
No, that is the value of the shares now. That is how the shares will
Okay.
be valued at. Okay. So that will give us 5,000, isn't it? Okay. Let's come to his return. Okay, his return. Then his return will be what? How many shares will we now be having?
1,600.
Okay. So the return will now be on 1,600 divided by 3.2 million. I hope you're okay with that. Okay. Multiply by 4,465,000. I like the way we are quiet. Yes, if you are learning new things, you have to pay attention. Okay. So let's move on. Okay. Divided by 320,000 multiplied by 4,465,000. I'm having 2,232.5.
Yes.
Okay. 32.5. What will be his total worth now?
Signalana,
Yes, please.
the 1,600. Where is it getting it from?
I wasn't the one who mentioned it though. I just wrote a figure there.
Is
the,
it
the
AV or?
1,002 plus the 400.
Okay.
So that's small thing that you're asking where we are getting it from. I thought you are struggling to get it. Just 1,002 plus 400 and you are okay. Oh, so now you don't have problem because your problem is not a problem. Okay.
No, like is the existing share, that's the 1,002 plus the right issue.
Exactly.
That
is the 1,000.
that's it. Yes.
Your problem should be of the same size of Ghana's problem so that we can address it. The problem is not a problem at all. So yes, if we are exercising the option, what will happen is that if we are exercising the option, what will happen is that, okay, someone can also decide over here. You see, someone can also decide over here. We bring the 15,000. but these shares will actually be valued at 3.75. Why are we doing that? It means that we have net the what? The cost against what? The number of shares that we are buying. Do you get it? This can be valued at 3.75. Then we bring the 15,000 over here. It means that we have taken the 25 from this one already before we value. Are we okay? Okay, so you can also do something like that. Let's come to okay, this one, how are we going to be saying it? He renounced part and will also take the part. The part we don't know which percentage is he renouncing. So you can just say he renounces the what? The right. But if you say he renounces part and take up the part, what is the part? Is it 50-50 or 60-40 or 30-70? Someone can use the what? The part. You can make a decision to your part. So we don't know the part that he's renouncing. So we just use the what? The absolute options. He does nothing, he exercises the option, or he renounces the option. Renouncing means that he is going to buy and sell all of them. Okay, so let's come here. What will happen now over here is that he renounces. Okay, so he renounces the what? The rights. So renounces the what? The rights. So what will happen is that we have the before. Okay, we have the before. Then what we are going to be having over here is we have the existing. We have the existing to be 1,000 at 30. That will give us 36,000. Then we have the savings account will be 15,000. Okay, that will be 51,000. There will not be any return because it is the right issue that is bringing the investments. So if before, it means that there was no right issue, so there will not be any return on this particular one. So let's come to after here. Okay, the after our existing, the existing will now be valued. Existing will now be valued at 28.75. 28.75. That will give us 34,500. Are we correct? Okay. Let's come here. Okay. If he renounces all, he will be getting a gain. He will sell it for 28.75, isn't it?
Yes.
So it means that he will get his 25 together with what? The gain of 3.75, isn't it? So let's now look for his gain. So the gain for him will be 3.75 multiplied by the 400 that he's buying. So he's selling. So we have 400 multiplied by, or 400 at 3.75. Okay. How much is he going to be getting? 1,500. Okay. So what will be the amount in his savings account? 5,000. No.
15,000.
The amount will still be 15,000 because we are buying at 25. We are now selling at 28.75. So it means that we get our amount that we used to purchase and plus a gain of what? 1,500. Okay. He's not going to, he will be getting a return over here, but a return will be on only 1,200, isn't it? Okay. So 1,200 divided by this one, multiplied by the 4,465,000. Okay, that will give us as the same as the first one, 1674.4. Okay, what are we having as a total?
52,670.
552,674.
0.4.
Is someone talking to him?
I think the person recommends a figure.
Okay, so let's come here. If the person does nothing, what will be the impact? You can see that his current figure will increase by what? You just look for. The question is asking you, evaluate the impact of the right issue on the what? So if the person does nothing, what will happen? There will be an increment of what? The difference between the two. If the person does nothing, that will be 51,74.4 minus 51,000. So if the person does nothing, you'll be getting a gain of his existing value will be increasing by 174. Okay, if the person exercises the option, what will be the increase? If the person exercises the option, what will be the increase? If the person renounces the right, what will be the increase? Those are the things that you'll be looking at. Those are the impacts. So you calculate and look at the impact. That is all about this one. That is nothing.
For how many months? Nine.
Yes, please.
With all these calculations for how many months? Hey.
Hello.
Yes, Ina.
I think this question is strange.
This question is what?
So when you are in the exam hall, I don't know if your brain will work faster like this to be able to do all this.
And then you do what you normally know. It will give you some marks, but not everything. Okay. All right. Okay, Senior, any question? I have PSC are done.
Hello.
Yes, please.
Yeah, please. What we saw is the capital structure.
Yeah.
Please, if you can run through it for me once again, please.
Okay. Okay. So the capital structure, what we are talking about is the capital structure. Capital structure, where are you? Okay. So the capital structure, they are saying that the company want to undertake an investment. Yeah. So the question is saying that the company want to undertake a project. They want to undertake a project. And let's look at that. So the company wants to undertake a project which is considering an investment of 10 million. It has two options of financing this investment. One is to borrow from the bank for 2 years at 10% interest. The other will be by the means of right issue. So this is our financial statement that we have. This is a financial statement that we have. Okay. This is a current financial statement without the borrowing. Okay. This is a current financial statement without the borrowing. So they are asking you to calculate the financial gearing. These are the financial gearing is calculated. What is given to you over here, the pro charge capital over the total capital employed. So if we are not doing anything now, it means that our financial gearing will just be based on our recent financial statement here, which is like this. So how do we find our proud capital? It is the long-term what? Debt, which will be the debentures, bank loans, plus the preference shares. So we add it. Our capital employed is just the total asset minus what? Total current liabilities, which is the same as you adding your shareholders fund, which will be your ordinary share, plus your share premium, plus your accumulated profits. Those are the items relating to the shareholders. Then plus your total long-term debt. That will give you the same answer as the total asset minus what? Total current liabilities. So we divide and we get our current. Without the loan, we have our current figure to be 57.73. Okay, that is the current one without the investment. Our long-term debt is 19,800. Our total debt plus our total shareholders fund is 34,300. Okay, now the question is saying that we should borrow. What if we borrow? If we borrow right now, it means that our existing debt of this figure will now increase by the 10 million that is coming. So our debt will now be 29,800 after borrowing. Okay. Then our capital employed, which is currently at 34,300, the debt will now come and increase it. And increasing it means that it will now be 44,300. Then we now calculate our financial gearing again. Okay. That is a second part. They are saying that it should not be a bonus, it should not be a right issue. If it is a right issue, it means that debt, our current debt will not be increasing, but our equity will be increasing. Okay, if the equity is increasing, it means our current equity will now be this plus this plus this plus the 10,000. Then we add a debt. So our existing capital employed without the right issue is 34,300. So if the right issue of 10 million is coming in, it means our equity is going to be increasing. Let's just add the 10,000 to this figure as a new capital from the right issue. So we now have the debt which is not increasing. Our existing debt will not be increasing because we are getting the 10 million from the equity shareholders. So we now have this figure to be 44,300. Then we find our gearing. So we'll be having 44.70 as the gearing if it is true right issue. Then you pick the one that is giving the lowest what percentage. Senior, I hope I've.
Yes, sir. I'm okay now.
Okay. All right. So seniors, I will see you guys.
Senior
tomorrow.
Linus, thank you.
Yes. All right.
Your question came in my quiz Sunday.
Which one?
Time value of money. The one that the question was about a loan. That 2,500 something. 2,500,000 loan. And then yeah, it is in your time value of money. But this thing they asked additional question, but your question was only the interest payment and the quarterly payment.
Oh, the same question.
The same question, but they added additional one.
Oh, sorry.
I think that day, I was sleeping as you were teaching, but I grabbed something, so I was able to write.
No problem. God is in control. All right. So, seniors, I will see you guys tomorrow, same time.
Thank you.
Good night. All right.